All right, ladies and gentlemen, I hope you had a wonderful day. It was another wild day, even though we didn't do a lot. So I hope you watched the video yesterday. You could go back, and even then, I am sure that we are going to keep talking about this. But what is going on in the bond market, my friend? It is very crazy. So I need you to like the video. I hope we see you there on stream, and I really hope you're paying attention. But I'm going to go a little bit deeper on the yield curve to kind of highlight what is going on. So if you were watching yesterday, what we have been talking about is that, hey, you know, the trend for the last year or two has been bonds and stocks have been positively correlated. And then all of a sudden, out of nowhere here, today was the second day of it. You're watching the bonds catch a bid while the market is selling off. Now, there's a lot of reasons, even the end of the year, and we're going to talk about that. But what a lot of people are noticing now is that the yield curve is getting very, very spooky. I've made a couple videos on this. I think even around like April or something when we were around here, I was like, yeah, this is getting wild, but look at this. So I want to get deeper in it, but the whole point people are talking about is that if the bonds keep doing this, some are saying this is like, yeah, the Fed is about to tighten us into a big mistake. But now this is why it's so important right here. You see, I'm like shaking it. I want you to look at, we're going to go back here. The last time the yield curve was this inverted, you get a little bottom here in 1981. You see that little drop here around 1979, and then you also bottomed out around 1978, and then you see how it went down there. Again, this going below zero means that it is inverted. Now, why is this important? Because this is the Volker era, and now Powell may be entering into his own Volker era, and this is what I want to show you because there is quite some interesting observations. Like I'm saying, through 1978, 1979, they were already raising rates, as you can see here. And then good old Volker, he comes into play in 1979. So as you get here into like March of 1980, that is where you had another one of those bottoms. I think it was like, what, right here? After it went lower, that was him just like excessively tightening. And you could see it here. Again, they were going up and up and up in rates, but then after that, they started cutting, and then he began raising a little bit more until you got to the 1981, and then it did all of that. But why are people bringing this up? Because they're saying, wait a minute, the yield curve is looking like this, but by the time we got to this point, you know, Volker did go a little bit crazier, but at the same time, some people are arguing that we were already kind of cutting rates. So it's getting very serious right here, and the point is this bond market thing that's going on, it is spooking investors. But now, I'm sure you're going to love this. I got the last part of it. Take a look at the S&P 500. So this was after the 70s, but here is like 1978, 1979. It didn't really do much, and then even after they got through that fiasco, again, one thing you got to keep in mind, there was a lot more. That was 78, 79, 81, and all of that, but you know, the market went through a period almost like 10 years of doing nothing, right? So that's what you got to keep in mind. But afterwards, you know, you don't really get anything from the S&P 500. So point is, what is happening now? This is either going to be something for the end of the year, but this is what has people talking about. They're saying, wait a minute, the bonds shouldn't be doing this. If they are doing it, even go look at the odds, like the Fed futures of rate cuts. Go look at like February, March, and all of the curve of the Fed futures for 2023. You're starting to get a lot of rate cuts priced in as people are buying the long end of the curve, and that short end is not moving. So this is very important. However, the timing is what makes it the most mysterious thing in the world. So I hope you guys are ready for that. I hope this helps you out, and this should explain now where we are going with everything. Today, you played around the 100 moving day average. You did it like 11 times, 12 times, but at least you didn't get a full sell-off. But again, we are below Powell, and how everything played out is getting kind of interesting. So I got plays for you. I'm going to show you what we did here today, and I have a little bit of breakdown for the data tomorrow and everything else in between. So I hope you already liked the video and did all that. We love you. I'll see you on stream, and run it, baby.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a little, but I still reinvest it. Feel how I feel, then it feel like a blessing. I just want the lesson. I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
But right off the bat, I just want to make sure you understand. last time we got this deep on the yield curve, they started cutting rates, okay? So keep that in mind, and that's not a good thing. It's not a good thing, but right off the bat, ladies and gentlemen, the bond market is screaming, and I'm telling you, I'm not the only one noticing now. Even though it's only been 2 days, it is very ferocious and fast, which kind of makes sense with the movements we've been getting, but something is going to snap. Now, this could be either good or bad. What you need to understand is either the bonds or the stock market, this turns out being nothing. The bonds are just going to give back their bid, and it doesn't mean that necessarily the market is going to have to come down. But otherwise, if you end up getting a rate cut, it might lead into something. I don't think that's the base case, but if we keep getting this dynamic and it gets further and the data kind of supports this over the next couple of days, I would not be surprised to watch people dump stocks and keep buying bonds. Again, this is why we have been so fixated on it over the last couple of days, but like I'm telling you now, it's getting weird. Everybody's assuming it is very hard to time. It's looking like the data is going to be the catalyst that gets everything to kind of snap back or confirm more of the move and then get it really, really running. So keep that in mind. As far as what we had today, it was quite an interesting one because you didn't get all of those immediate sell-offs. And even in the morning, you had those unit labor costs and productivity numbers, and it was actually good. The unit labor cost dropped, productivity was up. That's actually kind of one of the best things we could have saw, but it wasn't enough. And then you could also see just how it's played out over the last couple of days. We started off with a bid, but it ended up not lasting, but at least we did not flush the lows and you managed to hold a decently key level at the 100-day. But remember, even with all this going on, the levels will not be respected if something really, really pops off, okay? But you also had other things, and now today, even though you had China reopening news and all of that, the import-export numbers, that was not good, and that was bad, and this kind of even leads into it. It's like, okay, why are people buying the bonds and selling off stocks? Because a lot of weird demand destruction evidence is coming out, and that's even what China is showing us. Their numbers are bad for imports and exports. Even though they're reopening, you're not watching a bid on oil. You're not watching a bid on commodities. You're just overall not watching the demand that you would have expected to see from China. So there was that. There was also comments from Russia about like nuclear war and escalation, and we're going to talk about that when we get into the plays, but that weighed on the sentiment. And then Bank of Canada, they decided to go with 50 basis points, and believe it or not, it was split. There really wasn't an expectation. It was 50-50 between 25 and 50, and then they kind of worded it saying that they're watching the effect of rates, but they might want to keep going. So all of that weighed on the market, but you didn't really move as much. And then the Dow closed negative or right at green. NASDAQ dropped a lot, and then SPY was in the middle. All the while, the bonds caught another tremendous bid today. So that was part of it, and now I'll give you this one right here. I want you to know this before we go into what to look for tomorrow, but it's very, very simple. If this does not turn into anything serious, again, I'm showing you the history. This is an inflection point. If things were to get serious, it would probably be around these levels. However, if it doesn't, this still might prove to be an end-of-the-year illusion. But CPI on Tuesday next week and Wednesday for Powell, it is going to be a powder keg. But what I mean by the end-of-the-year illusion, a lot of weird things happen coming into the end of the year. Sometimes demand goes away. People go on vacations. Even by next year, we're going to have different funding on the bonds from the treasuries. And then on top of all of it, you kind of had the same thing happen at the end of last year. So this was 2021. It cuts off a little bit more of the chart. So you could kind of see here. Let me go back 2 years. Again, I just zoomed in on it. We had a pretty big drop, and then we were kind of recovering. But end of the year from the low all the way up here, you did get a decent move. That's on TLT. This is looking at the 10-year, but overall, it's not too uncommon to see this type of move. So if we even go to the 10-year, you'll notice this move was 93 to 99. That was about $6. This one was 113 to 116. This was about $3, but take a look. Fat gap into the bottom, then huge gap up. It's literally the same exact dates leading into the last month, and then as you got into the year, things started to change. So that's what I mean by end-of-the-year illusion. There could be other factors, and again, everybody has been willing to call a recession, and they want to call it. So that's what you got to be worried about. But we will see what happens. Now, as far as tomorrow, I think it has some potential, but again, I brought up Powell and the CPI beforehand because if we keep seeing this effect or with the bonds and all of that, I really just think those are going to be the big moves, and don't get distracted by anything else. But you will get the jobless claims as well as continuing claims tomorrow, and I think it's going to play out weird. So I believe that good news should be bad news tomorrow, and bad news will be good news. But I think it is going to be limited, or there will be a limit to that interpretation given everything going on. And then if it does not shake the bond equity dynamic that we've seen over the last couple of days, that would really mean something's up. But really what I'm trying to tell you here is that there will be a limit to good news, bad news, good news, and how that would play out would be essentially if we had a really bad jobs report where it was really, really bad, came in like 50,000 below, maybe even more, and people were worried about it. You would think it would have a good reaction because Powell could do this, or it means that the market's good economy. But if the bonds are showing this and people are getting worried, it might just further stoke any other recession fears. So we'll see how it plays out. I think it's going to be key. This is all going to be happening pre-market tomorrow, so you're still going to have to ride it out through the rest of the day, and then even by Friday morning, you're going to get more data, but you just got to stay alive till next week, and I think either this coming up data, it could reveal some of the answers here with what we've been seeing. Otherwise, I know for a fact we will get something by CPI, and then we'll go from there. But let us get into the plays. So right off the bat, I got a couple of plays. We made a couple of day trades today. Otherwise, I'm pretty much just holding what I was holding yesterday, but I did add RTX, and now this is a defensive. I talked about LMT yesterday. I ended up going with 100 shares of RTX at 99.14, and the reason why, they're just one of the cheaper defense plays. I said cheapest here, but it's like dollar for dollar. There is a couple of other ones, but RTX, LMT, Boeing, NOC, those are kind of the main ones that we have here. There's even like General Dynamics as well too, but like these are defense stocks, like defense, like bop, 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 like that type of like, oh, you know, the Russian, we're talking related to that. So I like it, but I like that it's cheap because all the other ones are really expensive. It's going to cost you a lot of money to get in, and it's also going to move a lot. So I figured, hey, 100 shares, $99, you know, a decent risk to reward. I do not like that all of these defensive plays are at the high right now, so that is part of the risk, especially if the economy or anything else gets worse and we do watch more of a downturn here. It does not mean these will be protected, but you heard from Russia today. There's been a couple of the attacks and a lot of other things, and I'm like, it is oddly quiet, and I think it could get interesting here, and maybe this is why people are on the bonds. I doubt it, but the point is, I'm open to anything right now, and the bonds are just saying, pay attention, bro. So believe it or not, I think, this is just my opinion, but I think some level of Russia escalation or hearing about it, I think it's a lot more likely now than any other time. But after the World Cup, again, that's how we started off the year. And what was it? It wasn't it was the Olympics with China. So we'll see how it plays out. I think this one's going to be key. I do like the defense stocks, but hopefully you see there is a little bit of risk there given how they're positioned, and they are really not the cheapest place to get into. And news just came out, Netherlands plans curbs on China tech exports and deal with the United States. Okay, but that is play number one. Play number two now, the bond. So it squoze me. Squoze, is that I don't know. I don't know if that's the right verb, but I got squeezed on it a little bit more today, but I'm just waiting for the data to either cut it and flip it. If I cut out of this play for a loss, I'm flipping to the long side because that's the only way I think it really gets ugly, and it would make a lot of sense. Otherwise, I'm going to be holding it short, and I plan to play the data, but it is a very interesting move right now. But what I'm saying here is that the yield curve really supports this idea, but it's a wild game of chicken before the data. Whether they cut rates or not, what I'm trying to tell you is that anytime you get these quick yield curve inversions, you have had snapbacks at various times. So it's either this is going to hold and lead to action, or it will be able to snap back. So we'll see with the data, but I really think this is probably the most interesting play in the market right now, and it's only going to start heating up. And like I'm saying, coming into 2023, this will be important to watch. So still on one short. Again, we can maneuver with size, but I'm waiting before I make a move because, like I'm saying, I could point out all of this stuff, but nobody knows right now. And that is what we need to be able to find out. But once we know, I think the fuel will be there for both directions. So let's get it, baby. But that is play number 2. And then finally, I hope you listen to this one. The last play is no play, man. Okay, the next couple of days, jobless claims, and what we're going to get on PPI. You see how this week played out? It might get tempting at the level, but it could be a distraction. If you want to make a move, just make up your mind and do it, but be very, very careful because everything is about Tuesday and Wednesday. Just if you got the balance, you got the budget, you got the skill, whatever it may be, and you're willing to ride in between there and you want to squeeze some out, it is all you. Again, I've been trying to go for some, but I even got trapped. I was able to do some here, but I am keeping in mind, even with what you're watching me trading, I have a lot more balance ready to go. But even then, a lot of today, I was like, you saw it. It was very boring, and it was very, very slow. So be wise. Don't get too emotional on any up or down moves, and just understand how fast the data could change anything and just how important it is right now. So we're getting into the final stretch, ladies and gentlemen. Thursday, Friday, going to have a good weekend. You're going to enjoy it, and then boom, we are going to get right to it, and we'll see where we go from there. So keep that in mind. A lot of speculators have been getting punched. If you have more of a midterm macro, don't be afraid of that. And then, again, you see how I'm playing it in with the events, but hopefully you're able to keep your eyes on the ball, but just be slow with a lot of things until we get the data. But it's going to be a wild runway, ladies and gentlemen. But those are the main plays. As far as everything else, still did a couple of plays. Again, I've been saying I need to get rid of the Carvana. They had that bad news. This was a small play, bro. I'm telling you, I think it was like $1,400, and I still lost like $800. I've lost more on this little small cap play than a lot of things that were way, way bigger with shares. So either way, that's what I get. I did not pay attention to it. I ended up closing out. They had that news there in the morning, but took about a $798 loss on that one. I opened up 50 shares of Tesla at 178.13. Thought we'd get a little bit of upside, and I waited somewhat, and I just liked the pricing that it was at near the bottom, and I said maybe they could hold up. And even towards the end of the day, they did decent. And then I actually ended up averaging down later in the day at 173. So now I think my average is 175 on 100 shares. This is going to be a swing, considering it part of the upside. And then we're going to see how we can add any other downside. And I'm still holding some of those other ones. But then I also took 100 shares of Netflix, 308. We've been talking about it. It dropped. I think I got like $3 a share, or like 250 or 280. It was decent. Closed out of that one, took profit. I opened 2 MESs, and then I ended up even closing 4 because my other ones I was like slightly up or slightly down. I said, you know what? It's doing this choppy thing. I don't want to do it. I ended up going back into it at the end of the day and just made all the money back. Got like $200 and ended up closing positive with all of it, even from the old MES that we were holding. But I had these plays open. I was like, I'm not liking it. I even closed the Netflix too, and then I opened up the RTX for the defenses right there. And I made a trade on Citi. They had the news, or the CEO was speaking during the event, so I thought I'd go for it, but started to go up a little bit. I lost 50 cents per share, $100 on 200 shares. I just cut out of it. Again, I didn't want to be tied to anything, and just with the market, a lot goes up, a lot comes right back down. So even though it's a day trade, my broader conviction, I was just going for the momentum, potential news event. It is very, very hard in this market, and that's where I'm like, okay, we might just need to play broader plays and go with the macro until the event, but doesn't mean there's not those opportunities, and I've been going for some of them, but either way, I had to pay for that. Same thing with PayPal. Went for one of those on 50 shares, ended up losing, I think, $1 per share, so got out another $50 loss, add that to there, 150, got to realize more with everything else, and then reopened 50 more shares at Netflix at 306.70. Again, I opened it at a way higher price, but I said, hey, I think it could still squeeze on me. That's what I was saying even when I opened the one in the morning. So the way I looked at it, I'll go with half. If it does have a run up, again, they're the outperformers. So if anything does pop off to the downside, I'm feeling we're going to get a dollar for dollar way more than any other play. So we will see. But those are the main plays. As far as everything else, we'll get to the hold-ins here. It's pretty much the same. Just now I have the Tesla with 100 shares down 230 on 100. And then the Netflix, again, it squeezed a little bit at the end, but was up most of the day. Still got the old Qualcomm, the Disney. They were clapping a little bit, even the Amazon. And then you can see here, I had a little bit more throughout the day. If you were watching, this little strategy, it got me back $2,000 when the market was break even in the morning. But after all the ups and downs and catch up, it was there. But now with kind of how we're viewing things, this makes me very, very comfortable. And I think we're going to be ready to position. And I may want to drop one off, but again, just making sure I got a little bit more ammo and waiting and giving it a little bit more time. So still holding that. And there's the bomb play. I still have the Yang play that's down. And then I don't know what's the other ones. I think RTX, that one's not up there again. Still holding that one. But those are everything. We are going to see how it plays out over the next couple of days. But watch the bonds, watch the equities, get ready for the data, and I hope you're ready for 2023. But that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. I need you to remember, baby, ain't nobody perfect. You getting better, but you ain't getting good. You know what I'm saying? Just remind yourself to stay humble. Always be improvement. Listen, I'd rather be the guy who thinks he's not doing anything right than the guy who thinks he's doing everything right. This will reward you, and be disciplined, but don't beat yourself up. Okay? You weren't meant to beat yourself up. You got a little bit more in you, but you're not meant to get too crazy with it. So balance the emotions. It'll probably be as important as balancing out the budget as we move forward from here, Chad. It is about to get wild. Welcome to the end of the year. Get ready for the data, and I hope you're ready for all of it. I hope I see you there, and thank you for doing it with me, baby. God bless you. But that is your watch. Wait, drink the water. Did I already say that? Oh, no. Do you drink it? Oh, drink water. Drink water. It's good. But I love you, baby. I'll see you in the morning. I'll see you on Cold Real Estate tonight. And that's it. I love you. Peace out. Horn.